In 1989, inflation in Peru went from 20% to 7,200%, and any success that my father and his partners had found in that software company just kind of got turned upside down. Any savings we had, purchasing power went to zero because we had it in Peruvian soles. I saw my father try to start business after business. He was very susceptible to the much faster business cycle that emerging markets generally have. And I got to see how his business efforts were closely tied to however Peru was doing at any given time. And so by the time I graduate from the University of Toronto, I knew I didn't want that, right? I knew I didn't want to be exposed to that level of business risk. I didn't want to be tied at the hip to the economic cycle. And so using the numerate skills that my father gave me, I went back as far as I could to try to understand how I could put portfolios together in a more thoughtful way that didn't make me as susceptible to these big crashes. If you're a financial advisor, I'm about to teach you how I applied this rarely used portfolio construction approach that helped me remove the negative impacts of the economic cycle from my own personal business risk, and of course, my family's financial risk as well. And so what we'll try to do in this video is identify what those risks are, and then we'll visualize how these risks have looked like historically based on your client's average portfolio composition, and we'll do a couple of examples there. And then finally identify how we may be able to fill in some of those blind spots that will help us minimize the disastrous impact that a negative economic cycle can have on both your business and your family. All right, so let's review the 5 ways that we can feel the wrath of an economic downturn. Now, Corey did cover these in a lot of detail in a recent video that was inspired by Meb Faber's framework, and you can find that right here. But the Coles notes are fairly simple. The first one is in your own personal portfolios. If the market drops, advisors are simply going to feel it just like everybody else. The second one, of course, is in their short-term business revenue. Most advisors charge a fee that is a percentage of client assets under management, and when the market drops, total assets under management drop, and that usually means a drop in revenue as well. The third is long-term business revenue. During a prolonged multi-year bear market, you and I both know that clients get scared. They don't want to put money to work, and oftentimes they withdraw their money altogether. And that will lead to further declines in assets and therefore further declines in revenue. The fourth is for advisors who are part of a much larger organization. If firm revenues fall enough, they might find themselves completely out of a job. And we like to add a fifth element here, and it's with those advisors that own their own business, those independent RIAs. And the way that works is that the value of their equity is usually estimated as a multiple of revenue. So in a severe bear market that lasts many, many years, with revenue low, the value of the company can drop dramatically as well. So with all this in mind, what we'll do now is to start by helping you visualize how these risks have looked historically, depending on your average client portfolio. Okay, so let's start with advisors who work predominantly with retirees. Now, this advisor will have a revenue-weighted average portfolio that is dominated by fixed income. Volatility in interest rates, which can be caused by things like sudden changes in inflation expectations or central bank policy, are likely to be the leading cause of revenue volatility. And that's kind of what we're showing you here in this chart, which is a portfolio that's dominated by fixed income. It's 80% aggregate bond index and 20% global equities. And what's interesting about this is that, yes, it's dominated by fixed income, but for the most part, this was a pretty smooth ride. And an interesting twist, the 80-20 split puts us in a very well-balanced position between two asset classes that are good for a growth and low growth environment. It's like two pistons in a motor working nice and smoothly. And when you do 80-20 with an aggregate bond portfolio that has a average duration of around 6 years, then it's actually a pretty good match. And that's why the drawdown in 2008 and the drawdown in 2020 isn't that bad. Having said that, in 2022, this was kind of the Achilles heel of a portfolio that is dominated by fixed income. Right? This is a time when rates go up that quickly, you're going to see equities and bonds go down together. And that is something that we hadn't seen in the previous, literally like 40 years since Volcker broke the back of inflation. And so it's been a bit of a Goldilocks moment for that 80-20 portfolio. Now we're starting to see the impacts or the negative cyclical economic impacts to our revenue if we are an investment advisor that focuses on retirees and has a lot of fixed income in the books. All right, now let's go to the other end of the spectrum. Let's focus on advisors who do most of their business with growth clients. That will likely see their revenue dominated by equity market risk. In this case, it would be wise for the advisor to plan for a period where the stock market crashes 30, 40, 50%, and with it, firm revenue. So what we're showing you in this graph now is the complete opposite end of the spectrum, right? We're giving 80% of our allocation to global equities, 20% of allocation to fixed income, and now we can see that we're really tied to that economic cycle, right? That recession cycle, the 2000 to 2003, 08, we're getting hit, 2020, and then in 2022, when rates spiked and there was a compression in multiples, then you can see that we're going to be susceptible to rate hike environment as well. So when we look at the landscape of portfolio management and investment advisory services, we really are just seeing somewhere in between those two extremes. And just like this chart depicts, there's another line here in the middle that shows a 50-50 bond equity portfolio. And you can see that the character changes slightly, but it's kind of the major ranges that we're going to see in asset management. And while we often argue in this channel that diversification is good for investors, we can also see why diversification would be good for financial advisor business risk, right? In an ideal world, an advisor's revenue-weighted average portfolio would be well diversified and be able to weather any market condition, providing significantly more stable revenues for yourself and your family and your business, as we've said a number of times in this video already. Okay, so now we're gonna get into filling in some of those blind spots. But before I do, I think it would be useful for me to tell you a little bit about my personal backstory and how I came to view the world of investing the way I do. I was, for those of you who don't know, I was born and raised in Lima, Peru. And I was lucky enough to be the child of a father who was a brilliant mathematician. He was also a software developer. In fact, he was a naval officer in the Peruvian Navy. He was sent to Monterey, California in the US to study operations research and software development, and came back starting to build the first computer that Peru ever had for the Navy. Those kind of punch card type of computers, that's what I'm talking. That's how far back it goes. And so from that, once he left the Navy, he started a software development company. It was fairly successful. And in 1989, everything turned on its head. In 1989, inflation in Peru went from 20% to 7,200%, and any success that my father and his partners had found in that software company just kind of got turned upside down. Any savings we had, purchasing power went to zero because we had it in Peruvian soles, and whatever money we had left, we used to emigrate to Toronto, Canada. Now, with that money, we were able to put my father was able to buy some real estate with very little money down, almost close to 5% last time I spoke with him. And what was crazy about that is that we hit the peak of the real estate cycle back in Toronto, where markets did drop 50%, something that I think nobody believes can happen again. We felt it. By the time we sold the house in the mid-90s, we were down 30%. So we had recovered a little bit from the bottom, and we had to do that because we were going back to Peru. So once in Peru, I saw my father try to start a business after business. He was very susceptible to the much faster business cycle that emerging markets generally have. And I got to see how his business efforts were closely tied to however Peru was doing at any given time. I finally left Peru to go to the University of Toronto, where I stayed with my brother, who was working as an accountant at KPMG, and he showed me his statements throughout the tech crisis while I was still in university, and said that he had just gotten absolutely slammed by his exposure to tech stocks. And so by the time I graduate from the University of Toronto, I knew I didn't want that, right? I knew I didn't want to be exposed to that level of business risk. I didn't want to be tied at the hip to the economic cycle. And so using the numerate skills that my father gave me, I went back as far as I could to try to understand how I could put portfolios together in a more thoughtful way that didn't make me as susceptible to these big crashes. And when you're going back that far, you're really not there trying to pick stocks and pick bonds, individual stocks and individual bonds. What you're trying to do is identify the big muscle movements that are going to get you to safety and kind of get you out of the way. And the discovery was fairly simple. You want equities for bull markets, you want exposure to sovereign bonds for non-inflationary bear markets, and then you want some exposure to commodities and gold. But one of the biggest things that really stuck out for me when I was looking at my different options was the managed future space. Because when you compare the different areas of the hedge fund industry, what you should be looking for are not more equity exposure, but at a lower volatility, which tends to be the case for these long-short equity managers. There weren't a lot of market neutral managers back then that I was able to get a hold of, but what I was able to find was managed futures managers that really have a unique sandbox to play in. They can diversify across dozens and dozens of markets, from global equity market indices, to global sovereign bond indices, to currencies, as well as a wide variety of commodities. And so that really covers the gamut of diversity that I could get my hands on. And moreover, they could go long and short those things. Now, the most popular style that we use in managed futures is trend following. Now, it's not the only one. We're gonna make a video on all the different types of styles that one can invest in with managed futures, global macro, and so on in another video. But if we focus on the trend portfolio, it was a very interesting offering because over the period that I had examined, it had zero correlation, or very close to zero correlation, to both equities and bonds over the long term. Now, because these mandates had the ability to be net long everything, net short everything, and net neutral everything, that was more of a conditional correlation. We could be correlated to equities and bonds when they were working. They could be negatively correlated to bonds and equities when they were not working, or they can be somewhere in the middle, somewhere neutral, right? So it really fit in for me what the big blind spots I saw in those economic cycles that the average investment advisor that I had interviewed for work at the time was doing. And so I started incorporating managed futures into client portfolios when I first got into the business and had the opportunity to start running money. So what we're gonna do now is I'm gonna show you what I saw back then in hopes that it inspires you to do things differently, to take that red pill and take a different approach. All right, so let's start with this next chart. This shows the traditional conservative portfolio that I showed you before of 80% fixed income and 20% equities. And you can see that it's kind of nice and smooth and then drops off in 2022. This green line at the top, what I've done here is made a very simple modification. I've simply added a third asset class, which is the SocGen Trend Index. Right, I'm not doing anything special about the proper weighting scheme between equities, bonds, and managed futures here. I'm introducing you to a concept here, right? And I often like to use the idea of a three-piston motor. Well, the majority of the investment landscape just uses two pistons. And in the black line, we have a bond piston that is really thick, an equity piston that is really thin. And so the car is going to move forward largely on that bond piston, moving us forward. And when the bond piston is down, we're going to get hurt, right? So what I'm doing now here is introducing a third piston, and we're making them equal dollar weights here, right? So we're trying to make those pistons a little bit of the same size, and we want to have that third piston to be able to go up when maybe equities and bonds go down together. And we see this. The benefit of this in the year of 2022, you can see the tail end of this chart shows a much smoother ride. We kind of minimize that sequence of return risk that we are all susceptible to, especially if you're a retiree. And when we compare the prior experience from 2000 and 2022, we see that it's very similar to that 80-20 portfolio. That kind of adverse scenario risk is smoothed out in 08, in 2000, and 2020. Okay, so this is what I mean by adding that diversifier. And it seems, and we're not doing anything special here, right? It's not like a crazy back test of 20 parameter sets doing different things. What we're doing is simply putting an equal weight portfolio of three structurally diversified strategies together. And oftentimes, we like to say that diversification done properly is indistinguishable from magic, but it is that simple. Okay, so now moving on to the moderate risk portfolio. This blue line here is a 50% equity, 50% bond portfolio. And while it may seem like it's an equal risk portfolio, the reality is that the 50% in equities dominates the risk. And so you still see that susceptibility to the economic cycle that you'd see much less of in that green line. So again, the green line is an equal weight portfolio, a third, a third, a third between those three asset classes. The only thing that we're doing different here is we're expanding the gross exposure to have 40% equity, 40% bonds, and 40% managed futures trend. And so we're adding a 20% stack on top of managed futures trend in order to maintain the proportions, maintain that kind of smooth equity line or a smoother equity line. But now we're increasing the volatility and increasing the drawdowns that you would experience in contrast to a non-stacked one-third, one-third, one-third portfolio. Okay, so this is now increasing the risk for a moderate risk investor. If we move on to a growth-oriented investor, an investor base, the traditional way to do this is to now skew very much into equities, 80% equities, 20% bonds. And now we're fully susceptible to the economic cycle. And we are going to be managing a lot of emotions in short periods of time, but also, it feels good to be up when there's a prolonged multi-year bull market that you can take advantage of. Having said that, again, what we're looking to do here is to smooth out our risk in the business cycle, our clients' risks, and so on. So by having that third portfolio, but now what we're doing is we're giving 50% to equities, 50% to bonds, and 50% to managed futures trend in order to increase the return that is required for that client base, but also you're increasing the volatility, you're increasing the drawdowns and the risk in contrast to the previous two portfolios. So putting them all together, what we can see here is that we've accomplished our goal of bucketing different portfolios for different risk buckets. Our conservative mandates get lower volatility and lower drawdown. Our aggressive mandates get higher volatility and higher drawdowns. But ultimately, the adverse scenario risk remains kind of similar across the three different buckets. So we've stretched out that equity line, we've reduced the business cycle risk, and we've created a set of portfolios that really meets those traditional needs of risk bucketing across all of our client base. Now, what's obvious here is that in order to do this, you need to have access to professionally managed and cheap leverage. And while that wasn't available to me back in the 2000s directly in public products like ETFs and mutual funds, I had to go out and find the hedge fund managers, convince them to create a private pool in Canada, put the private pool together, seed the private pool, and I could only offer it to accredited investors at the time. Today, all of that has completely changed. We now have a wide variety of exchange-traded funds and mutual funds that come with pre-packaged stacks that will allow us to get access to well-managed, cheap leverage and put these type of portfolios together. And so just what have we actually done with those three buckets? We've created, the first portfolio doesn't require any stacking at all, right? It's a third, a third, a third. You're just diversified. The second portfolio is 40, 40, 40, which means that you're gonna have to find a 20% managed future stack somewhere in order to have that expanded canvas, that expanded growth exposure. And then the third one is 50, 50, 50, so you're gonna have to find a way to get that extra 50% exposure to managed futures trend. So using the return stacked approach to diversification at different stack sizes for different client personas means that advisors and their clients are finally well aligned. And when we talk about alternative investment strategies and how you can use techniques like the ones above and return stacking to introduce them into your portfolio, it's not because they're inherently good, but because diversification is inherently good. It's called the only free lunch on Wall Street because combining non-correlated assets into a portfolio, you can now have wealth that compounds at greater consistency. So if you're a financial advisor, finding ways to introduce diversification into a client's portfolio not only has the possibility of improving the resilience of the financial plan, but also the stability of your business. So I hope this was useful to you in really taking that red pill of diversification. I know we didn't have access to these things. Really, our only choices for the last 10, 15, 20 years had really been to be heavily weighted towards equities and heavily weighted towards bonds or leaning on equity managers to pick better stocks to try to manage some of the risk to the downside, but that's no longer the case. We now have the solutions in place. So if you liked what you heard in this video, please do smash that like button and subscribe to the channel so that you can be abreast of any other videos that we put out in the future. Also, if you have any comments, please put them down below. We like to interact with our audience. We like to be told when we're wrong or when you like what we have to say or we don't like what we have to say. Let's start a dialogue. And finally, if you want to reach out directly to us, you can go to returnstack.com where we have a wide variety of tools that'll help you visualize the benefits of return stacking. We have a portfolio visualizer tool and a safe withdrawal rate visualizer tool that'll help you kind of understand what different stacks and different diversifiers can do in terms of improving that outcome for your clients and your business. So do reach out to us if you're an advisor and you want to get access to those things. Okay, that's it for now. I hope this video was useful, and until next time, happy stacking.